Have you ever wondered how you could access your IRA completely tax-free? Well, in this video, I'm going to give you 2 strategies on how you can access your IRA assets and not have to pay taxes, penalty taxes on that withdrawal. All right, let's get started. Okay, so if you listen to my opening right there about accessing your IRA tax-free, you're probably wondering, why hasn't anybody told me this before? That's not true, Clint. If you take money out of your IRA, you're going to be hit with income taxes. And if you take it out early before age 59 and a half, you get that extra penalty tax that's going to play on top of that. Well, here's the deal. If you're going to be accessing your IRA, if you need those funds for business or for investment purposes, then you do have the ability to access your IRA and help either offset the tax or avoid the tax altogether. And this video came about because I was working with an individual who had taken money out of his IRA, and his CPA was telling him he had to pay all this money to the IRS in taxes. Basically, they're telling me, hey, you owe the IRS about 47% of whatever you pulled out in taxes for this particular year in question. And so I sat down with him. We started analyzing what he did with the money. And I started showing him how what he thought or a CPA thinks when it comes to paying taxes doesn't necessarily bear out, that he's not going to have that tremendous tax liability on his IRA. So that's going to be the first strategy I want to share with you on accessing your IRA tax-free, what he did and how you may want to consider this as well. So he had this IRA that he'd set up, that he'd had for years. It was a rollover from a 401k plan that he had. So his money's sitting in this IRA. And he decided that he wanted to go into short-term rentals. So he had this property that he wanted to develop out to turn it into a short-term rental. So he took money, he closed out his IRA, and he took money out of it. Let's say he took out $375,000 out of his IRA. And then that money was turned around and was invested into this property. So he also got a loan to buy the property as well. So let's say the total cost of this property here was $700,000. So he did this and he built this property up, and then he started renting it out on a short-term rental basis. Now, understand that this individual who was doing this, he was doing it all on his own. All right. He was the one that was out there managing the project. He was spending, every day, because it just so happens that he lives right next door to that property. He has another lot where he bought a house. And so this is his home. So every day he'd just get up, have his cup of coffee, do what he normally does in the morning, and walk over there and start working on the project or managing the contractors that he was bringing in to help on that project. So he's spending significant time here. After this project was done, then he started renting it out. And the average rental period happened to be 7 days or less. That's key here for this strategy I'm about to share with you. So what happens? Well, when his CPA approached him and said, all right, Scott, you got to pay 47% of this $375,000 that you withdrew to put into this in federal taxes, plus interest and penalties because you didn't pay it as soon as you pulled it out. He called me up right away and he said, is this true? Do I need to pay this tax? I said, well, let's look at what you did, Scott. You took the money out, you put it into this property, and you turned this property into a short-term rental. Now, did you spend 100 hours or more on that property, materially participating in working on it? He said, 100 hours? I said, heck, I spent probably 700 or 800 hours on this property. I said, do you have that documented? He goes, absolutely, I've got it all documented. Okay, perfect. So what we're going to do is we're going to qualify you as materially participating in a short-term rental business. So that what that's going to allow us to do now is take this property and we're going to do a cost seg study on this property. So we brought in a cost seg authority. It's a group that we work with. There's a link in the show notes. If you want to do a cost seg on your properties to do exactly what I'm going to be talking about here, go to the show notes. It's a very reputable company. I've been working with them for many years. They've done my cost segs on on my real estate portfolio. And what I like about them is that they analyze and they tell you, hey, it doesn't make sense to do it on this property, or it makes sense to do it, but not this year based upon your tax liability. Let's push off to another year. So, and they'll even uncover opportunities for you where you think may not work and it actually does. So anyways, that's a little plug for them because I do like working with them. Now, so we ran a cost seg on his property. And it just turned out that by running that cost seg on that property, we determined that he was able to write off about $315,000. So we got a $315,000 tax deduction on that overall property. Now the property had gone up in value, of course, and so we had a lot going on here that allowed us to create this type of deduction. But the point is that we took that deduction and we used it to offset that distribution from the IRA. So when you're thinking about accessing your IRA, one way to gain access to your IRA tax-free is to find deductions that you can use to offset the income. And real estate is a great opportunity here. Short-term rental real estate with a cost seg, or claiming yourself to be a real estate professional and performing a cost seg analysis on your property. Now, for those of you that are familiar with the strategy, you're going to start hitting me right away. Well, Clint, what about bonus depreciation? You didn't mention that. That is implied. You definitely want to take advantage of bonus depreciation. That's what we did here. And what made this strategy work is based upon when we acquired the asset. So that's important as well. That's why you want to work with somebody who understands it. So that's option number one. Now, you see, the problem we have here is that Scott came to me after he'd already done this. Okay, he didn't talk to me before. And this is one of the things why we created our Platinum service here at Anderson, where you can call in, you can speak to our strategists, you can speak to the attorneys, you can even talk to CPAs, and you're not charged an hourly rate. And so we have, thousands of Platinum clients that have understood the benefit in being able to reach out to someone who is knowledgeable before you take action, to be able to get on the phone with someone and say, hey, this is what I want to do. Where are the landmines for me? You see, he's not a Platinum client, but he's a friend. He should have just picked up the cell phone and called me and told me what he wanted to do. And I would have structured this deal so he wouldn't have paid any tax. And we wouldn't worry, we'd still get the tax deductions and breaks from depreciating the property, but there's be no tax liability to him. How would we have done that? Well, what we would have done in that instance is we would have created a corporation. I would set up an Inc., taxed as a C Corp. I would have set this up. Then I would have established for him a solo 401k plan. So we'd set up a solo 401k for him like this. Now, when this solo 401k, Scott's going to be here and Scott's going to be over here as a participant in the 401k, and he's an officer in his new corporation. We would then take the IRA. Now, the reason this strategy works is because it's a traditional IRA. If it was a Roth, we couldn't do this. But because it's traditional, we can. We would take this IRA and we would roll the funds into the solo 401k. Now, if he's married, okay, if you're married, you can do this with your spouse. Okay, so if your spouse, bring her in as an officer, and if she had an IRA, a traditional IRA right here that she owned, or she had money in, you could roll those funds in. So, he could roll in $375. If she had $250, she could roll her IRA in. So now we have this combined pool of money inside of here. What's that, $625? Sitting inside of that overall plan. So let me just get rid of this stuff here because these no longer exist. We shut them down. We put our money into the solo 401k plan that is sponsored by their Inc. Okay, so that's the first step here. Now, what you notice is I didn't say who the owners of the corporation are initially, because this is where the magic comes in with this strategy. See that rollover, moving the money from the IRA, that IRA rollover, excuse me, that IRA rollover is tax-free, right? So when you roll from an IRA into a 401k plan, that is considered to be a tax-free rollover, as long as it's a traditional IRA. If you have money with a 401k with a prior employer, you can roll that over tax-free. You can't do it with a Roth. So if you got Roth money, you might as well stop watching this video right now because this strategy doesn't apply to you. So anyways, it's a tax-free rollover. So we move that money into the solo 401k plan. We park it there in an account. Typically, I set my accounts up with Charles Schwab for the clients where we do this type of strategy. So they have the money in there. They have a checkbook control over that account under their solo 401k plan. Oh, by the way, that is not a Charles Schwab solo 401k. This is a solo 401k that we create for our clients, or you'd have to use a third party to create, because Charles Schwab, even though they offer it, their plan will not allow what I'm about to show you. So don't try to set it up with them. You have to use a third party that is experienced in this matter. So now what you do is once you've set this up, you've got this money in there, it was tax-free rolling it over. The idea is I want to take these funds and I want to go out there and buy that property that I was talking about and go into the short-term rental business. So I need to get them out of here and over here to buy the property. Well, you could borrow money out of this plan. I could borrow $50,000 each, but that's only $100K. And in my example, what I showed you is he needed more than that to do this transaction. So since this is limited, what I would do in this scenario is I would take out your $50K each. So first I would take a loan. So I give him, he and his wife, each $50,000. So that takes our $625 that was in the plan, and it drops it now down to $525. Okay. So then I take the $525 that's remaining, or I'll take $500 of it. I'll take $500 of the $525 that's remaining, and I'll buy stock in this newly formed company. Now this is what's key here. This has to be a new corporation, new Inc. in order for this to work. If you have an existing company, you got to set up something brand new. So I'm going to take the $500,000 and I'm going to buy stock in this company. Maybe I'll take each of these guys here. I'll take my $100,000 and I'll buy stock personally. So I'll move in $600K, $500 from the solo, $100 from the two of us. So that company then will issue out stock. 5/6 of the stock that's been issued, okay, would be owned by the solo 401K, and we would own 1/6 of that company. So depending on how many shares you issue, maybe you have a maximum of 1,000 shares. You just go in and figure out the math there and divide it up accordingly. So now I've got the money in here. This move from your solo 401K into your corporation is tax-free. That is tax-free. It's not taxable because now your solo 401K is making an investment. It's investing into your plan. Now, you've probably heard about prohibitive transaction rules with regards to retirement plans. This is an exception to that general rule. What makes it the exception to the rule about self-dealing is the fact that this is a newly formed company. Okay, so that is the exception here. So now when my money is placed inside of this company, I'm then going to use the company to go out and make this purchase and run the short-term rental business through this corporation. So the income, yes, will come to the corporation. And yes, the corporation can perform the cost seg study and depreciate and take the depreciation against the income. So it can operate just like you are doing when you own the property in your own name. But the idea here now is that, remember my example, if I said if you had $315,000 from a cost seg study and your property is generating, say, $65,000 a year, well, you have quite a few years of profit that you're going to, or income you're going to be generating that you're not going to be paying tax on because of this loss here just from running that cost seg study on the asset. So using this strategy can make a lot of sense for people who have assets inside of an IRA and they want to get access to those assets but not paying tax. Now, I want to throw some caveats on you. Number one, you have to have a business to do this. You can't just use this to move money into here, then loan it out to yourself. I've had some people ask me that. Hey, can I just borrow the money back out? No, you can't. You actually have to take that $600K and invest it into the corporation's business activity. But the profits that come from that business activity, you can definitely take out of the business because that's what it's designed for. Okay, now, so that goes back to the profits. People ask, well, the profits the corporation makes, is it tax-free to the corporation since, in my example, 5/6 of that corporation is owned by the solo? No, it's not. It is taxable. Remember, this is a C Corp. It's not an S Corp. It's not a flow-through. Pension plans, 401ks cannot own an interest in an S corporation. That's why I said an Inc. C Corp. That's critical here. You cannot do this with an LLC. So the business is just a stand-up business. Any income it generates that it doesn't expense out is taxable to the corp at its flat 21% tax bracket. Now, if you want to unwind this transaction, all you would do is buy the stock back from the solo 401k. When you're buying it back from the solo 401k, let's say the value has gone up. Now the company is sitting on $2 million, then 5/6 of that $2 million that you pay over to your solo 401k would in fact be tax-free to the solo. Okay, it's tax deferred to you, but it's tax-free to the solo. So there's lots of different ways we can run this. You can even, inside of the solo 401k, roll money potentially from there into a Roth, so it's tax-free when it comes out to you. It's just understanding that you have options, and that's the thing about planning. As I talked about in the middle of the video where I said, hey, becoming a platinum client gives you access to work with our attorneys here at Anderson, our CPAs, and you don't have to pay an hourly fee. It's the reason why we set that up is because so many people do not reach out, like my friend did, before taking action. and just saying, hey, let's talk about this and see if there's some better way to do it. I get it. Why don't we do that? Because many of the professionals with whom we associate locally do not understand it to this level, and they may not give you the right type of advice. And so you figure, hey, why even bother? Because they're not going to give me the answers I'm looking for, or they give you the wrong answers. And so that could become a problem as well. So this is how you can act. Two different ways in which accessing your IRA, you can make it tax-free or nearly tax-free for using the deductions. But just things that you should keep in mind, that if you're building a business, you have money in an IRA, there are options.